All right, let's just dive right into this explainer, because we really need to unpack the hidden mechanics behind what's shaping up to be the absolute largest initial public offering in human history. Seriously, we're looking at a financial maneuver so massive and honestly so quietly orchestrated that it's literally rewriting the rulebook of modern investing as we know it. Just to set the stage here, SpaceX is reportedly targeting a jaw-dropping valuation of $1.75 trillion. Let's just put that monumental number into perspective for a second. At that valuation, SpaceX would be worth more than every single American defense contractor combined. It'd be worth more than the market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks all smashed together. It's almost hard to wrap your head around. But here's where things get kind of wild, because this massive valuation brings up a glaring contradiction. If you actually look at the bottom line, the consolidated company is bleeding cash. They're losing right around $5 billion a year. So the obvious question we really have to ask ourselves here is, who on earth is stepping up to buy a company losing that much money at the absolute highest IPO valuation the market has ever seen? Well, the shocking reality, and what we're going to uncover in this explainer, is that you are. Specifically, your retirement account is set up to be the guaranteed buyer here, whether you actively choose to be or not. But before we reveal exactly how the financial system is maneuvering to make you the buyer, we kind of need to look past the rockets for a second and understand what this company actually is today. So let's get into Section 1, the biggest IPO ever. You know, if you ask a random person on the street, they're probably going to say SpaceX is just a rocket company. Or maybe they'll mention colonizing Mars. But the rule of three totally applies here. SpaceX isn't just one single entity. It's actually three completely distinct businesses stacked on top of each other. And surprisingly, the rocket business isn't even the most crucial piece of the puzzle. Moving on to Section 2, inside the SpaceX empire. Let's dig into the actual numbers and see how this empire is built, starting with the most controversial and frankly overvalued piece of the whole pie, xAI. So a few months ago, SpaceX acquired xAI, which is the artificial intelligence lab founded by Elon Musk to compete with OpenAI. It was an all-stock deal that valued xAI at a staggering $250 billion. But look at reality for a second. OpenAI generates around $24 billion in revenue and is valued at $850 billion. Anthropic brings in over $30 billion and is valued around $400 billion. xAI, it has an estimated revenue of just $1 billion, yet it was bought for $250 billion. The market is basically pricing it like a premium luxury airline when the financial fundamentals look a whole lot more like a budget carrier. And honestly, it gets worse. To use a brilliant metaphor from our source material, xAI is essentially the reverse Jerome Powell of the company. Instead of printing cash, it's lighting about $1 billion a month on fire. Think about that. By March of this year, every single one of its 11 heavyweight co-founders had walked out the door. The company essentially had to be completely rebuilt from the foundation up. So that $250 billion price tag, that was placed on an asset that was basically starting over from scratch. Okay, let's pivot to the completely opposite end of the spectrum, Starlink. This right here is the absolute crown jewel of SpaceX. It's essentially Comcast, but in space. In 2025, Starlink generated $11.4 billion, which made up an incredible 61% of SpaceX's total revenue. Meanwhile, that famous rocket business, it only brought in about $4 billion, which is roughly just a quarter of the total pie. And this brilliantly illustrates Starlink's true superpower, which is its accelerating efficiency. Its profit margins jumped from about 41% 2 years ago to an absolutely massive 63% this year. It's got over 10 million active subscribers across 150 countries, and it's rolling out to maritime shipping, commercial aviation, and, yep, even the Pentagon. Which brings us to Section 3, the $5 billion loss. So, how does a company with Starlink, this highly profitable cash-printing machine, end up deeply in the red as a consolidated whole? Well, let's just do the math. When you combine the profits of Starlink and the rocket business, SpaceX generated a very healthy $8 billion in profit. Awesome, right? But then xAI crashes the party. Because xAI burns through roughly $1 billion a month, that's a $12 billion annual loss. Subtract that from the $8 billion profit, and you are left with a consolidated company that lost nearly $5 billion last year on roughly $18.5 billion in revenue. Yikes! All right, Section 4, rewriting the rulebook. And this brings us right back to our original mystery. How does a company that's actively losing $5 billion successfully secure a nearly $2 trillion IPO where your 401k is basically forced to step in and buy it? Well, the answer lies deep in the financial plumbing of the stock market. You see, NASDAQ quietly changed its rules right before this IPO. Under the old rules, a newly listed company had to wait 3 months to join the prestigious NASDAQ 100 index. This gave the market time for price discovery, to figure out what the stock was actually worth before passive funds were forced to buy it. They also required a minimum of 10% of the company's shares to be publicly available, which is known as the free float. The new rules, that wait time is compressed to a fast entry of just 15 days, and that 10% minimum float requirement is completely gone. These sequential rule changes weren't just some random coincidence. They rolled out the red carpet. SpaceX is reportedly targeting a free float of just 4 to 5%. 6 months ago, that would have been an automatic disqualification. Now, they can skip the standard seasoning period, list with a tiny fraction of shares available, and get dropped straight into the index. And by the way, this runway wasn't just cleared for SpaceX, it was quietly tailored for a whole class of tech giants eyeing public listings this year. But wait, because the absolute most shocking mechanism buried in the technical language of these new rules is the hidden multiplier. Because SpaceX's float will be under 20%, NASDAQ will treat that tiny float as if it were 3 times bigger than it actually is for index weighting purposes. So a 5% float gets weighted at 15%. This legally requires ETFs tracking the index to engineer artificial manufactured demand, pouring literally billions of dollars into the stock based on an inflated multiplier. Which leads us to Section 5. Your 401k is buying. This brings us directly to you, the viewer, and the trap currently waiting inside your retirement account. Because all this manufactured demand requires capital, right? And that capital has to come from somewhere. In a standard IPO, companies set aside about 5 to 10% of their shares for everyday retail investors. But SpaceX is rewriting that standard too. They're specifically targeting a massive 30% retail allocation for this offering. When SpaceX CFO Brett Johnson spoke to bankers, he framed this really unusual 30% allocation as a reward. He said they wanted to recognize the incredible support retail buyers have shown for Elon Musk over the years. But if we translate that out of corporate speak for a second, the reality is that the largest IPO in history is preparing to dump 30% of its supply directly onto regular retail buyers. And as portfolio manager George Noble so bluntly put it, your 401k is the exit liquidity. This is just how the system works now. Early insiders sitting on low-cost shares get unlocked later, while passive funds and retail investors are forced in early. If you have any sort of retirement account holding U.S. stock index funds, the mechanics of passive investing will automatically force you to absorb these overvalued shares. You won't have a vote, and you definitely won't have a choice. Which leaves us with this final, really provocative thought. Passive investing was sold to all of us as common sense, right? Low fees, easy diversification. But the very feature that makes your 401k a convenient set-it-and-forget-it tool is exactly what makes you the ultimate safety net for Wall Street's most expensive illusions. When the rules can just be changed quietly to manufacture demand for an unprofitable $2 trillion company, we really have to ask, who is actually benefiting from your passive investments? Thanks for joining me on this explainer, and definitely keep your eyes on the fine print.